Chapter 4, Part 3. Now we're going to do a multi-step income statement and a classified balance sheet. Now a single step usually, it's done by service providers, but usually companies that have inventory will do a multi-step income statement. So we're going to look at this and say, okay, if we're going to prepare a single step, what accounts would we use? Well, we're going to first find all of our expense accounts. And remember, cost of goods sold is an expense account, and our revenue accounts. Now we've identified them all, and this would be our income statement, single step. Now, if we were to take that same information, remember you always get the same total, whether you do single or multi-step. Now, the reason we do a multi-step for merchandisers is because they have the account called cost of goods sold, and we really want to know how much profit are we making just on selling a unit, not including all the other costs associated with it. So you can only have gross profit when you do a multi-step because it's the difference between sales revenue minus cost of goods sold. Then we'll list our operating expenses, including selling, and that'll give us operating income. And then we'll take out or add in any other revenue or expenses, which normally is interest or gain or loss on any sale. So now we're going to take the same item, use the same accounts, and do our multi-step. And here it is. Now you notice net income is the same regardless if used, but however, we have this new title called gross profit. And that's something investors are always looking at. So now we're going to take the same information and prepare our statement of retained earnings. In this case, we would check the adjusted trial balance and get the beginning balance plus net income, check to see if there are any dividends. There aren't. And that number is what is going to go in the balance sheet. Remember, that's the number you use. Classified balance sheet. We always list our current assets first based on liquidity. And here's a good, nice example for you. It lists what we consider current assets, long-term assets, this just builds, current liabilities, and long-term liabilities. Usually assets have the most categories. So these are examples. So now let's take a look at our classified balance sheet. We would start with our cash and end with our prepaid rent. And that would give us our, and this is also where estimated inventory returns appear. And remember, it follows inventory. Then we would list our long-term, including PP&E. Then we would show our current liabilities and long-term after that, and then our equity. And remember, the retained earnings you use is the one from the statement of retained earnings. Now, you double line to indicate that you're at the final total. So that's how you know. Oh, and the other thing is you also want to make sure those two equal because a balance sheet has the balance. Okay. Now let's look at a couple percentages on what we would do with our income statement at this point. So first we're going to look at earnings per share. Earnings per share is the portion of the company's earnings allocated to each outstanding share of common stock, serves as an indicator of a company's profitability. Earnings per share is computed by dividing the corporate's net income or net loss by the average number of shares outstanding during the year. So if we assume they have 10,000 shares, average shares, in this example, they would have earnings per share of $1.215 or 1.22 earnings per share. Now, is that good or bad? The only way you'd know that is by comparing it to prior years and comparing it to similar companies. Now, the next thing we're going to look at is the gross profit. This tells you how much of each dollar of sales is left over from the cost associated directly with the goods sold. So in this case, we end up with 47.5%, which tells us we're keeping 47.5 cents of every dollar of sales to cover our other expenses. Again, is that good or bad? It depends what the industry averages look like. And I'll give you an example. If you're a software company, your gross profit percentage is usually about 70% because all of your costs are in research and development and advertising. Whereas another example would be a staffing service. Their gross profit is about 2%. The reason is all their costs are in labor, which are the goods that they're selling. Net income percentage. This tells you how much of each dollar is retained after a sale. And in this case, we have 30.4%. Now, that means you're keeping 30.4 cents of every dollar of sales. Now, is that good or bad? I think that'd be pretty darn good. However, that'd be very high for most companies because the thing is, the more money you make, the less that ends up on the bottom line because it's hard to keep that gross margin because competition. That ends this presentation.